In 2011, JCPenney operated more than 1,100 department stores across the United States and generated roughly $17 billion in annual revenue. It anchored shopping malls, employed over 100,000 people, and served a customer base that spanned generations. For decades, it had been a default destination for middle-income American households. Within a few years, that position no longer held. JCPenney's strength had been built slowly. Founded in the early 20th century, it expanded alongside suburban America, embedding itself in regional malls and town centers as those spaces became the commercial core of daily life. The stores were large but not aspirational. They sold clothing, home goods, and basic necessities at prices intended to feel reasonable rather than luxurious. The brand promised fairness and familiarity. Shoppers did not go to JCPenney to be surprised. They went because they knew what they would find. By the early 2000s, that model still appeared viable. Department stores were under pressure, but JCPenney retained a loyal customer base. Its pricing strategy relied heavily on promotions, coupons, and sales events, a system that trained customers to expect discounts but also drove steady foot traffic. Margins were thin but predictable. The company did not dominate headlines, but it remained profitable. Internally, there was little sense of crisis. The business seemed stable, if unexciting. The retail environment, however, was already shifting. Big-box competitors had improved their private label offerings. Specialty retailers targeted narrower demographics with clearer identities. Online commerce, while still a minority of sales, was changing how consumers browsed and compared prices. Younger shoppers were less attached to department stores, while older customers were aging out of peak spending years. None of this was invisible to JCPenney's leadership, but none of it yet demanded radical action. That perception changed abruptly at the end of the decade. Sales growth slowed, mall traffic declined. Promotional pricing, once a strength, began to look like a liability as competitors matched discounts more efficiently. Investors grew impatient with incremental adjustments. By 2010, JCPenney was no longer seen as merely stable. It was seen as stagnant. In that context, the board sought transformation rather than optimization. They recruited Ron Johnson as chief executive in late 2011. Johnson was not a department store veteran. His reputation came from elsewhere. At Apple, he had overseen the creation of the Apple Store, a retail concept widely credited with redefining how consumers interacted with technology brands. Before that, he had worked at Target, helping shape its design-forward mass-market positioning. To the board, he represented clarity, modernity, and decisiveness. Johnson arrived with a diagnosis. JCPenney, he believed, had trained customers to distrust its prices. The constant cycle of coupons and sales created confusion rather than loyalty. Shoppers did not know what items actually cost. They waited for discounts instead of forming attachment to the brand. In his view, the solution was not better promotions, but their elimination. The strategy he introduced was simple in concept and sweeping in scope. JCPenney would abandon sales, coupons, and markdowns. Prices would be set lower, transparently, every day. The company called it fair and square pricing. Alongside this, the stores themselves would be reimagined. Traditional department layouts would be replaced by branded shops within the store, each with its own identity. The aim was to make JCPenney feel curated rather than cluttered, modern rather than transactional. From a distance, the logic was coherent. Everyday low pricing had worked for other retailers. Brand partnerships could refresh the assortment. Simplifying the shopping experience might attract customers who found department stores overwhelming. Internally, the changes were framed as overdue. The old model, Johnson argued, was not merely outdated but actively repelling younger consumers. What the strategy underestimated was how deeply JCPenney's existing customers depended on the old system. For decades, shoppers had navigated the store through promotions. Coupons were not incidental. They were the mechanism by which customers felt rewarded for loyalty. A 30% off tag did not simply reduce a price. It signaled value. Removing that signal changed how customers interpreted every rack and shelf. When the new pricing launched in early 2012, the immediate effect was confusion. Prices were lower than the previous list prices, but higher than what customers were accustomed to paying after discounts. Shoppers who came in expecting a sale found none. Coupons stopped arriving in the mail. The absence felt less like simplification and more like loss. At the same time, the physical transformation of stores was incomplete. Many locations were partially remodeled, creating a patchwork of old and new. The promised shops were unevenly executed, and some brands failed to resonate with the core customer base. The experience did not yet justify the disruption. Sales declined rapidly. Within months, same-store sales fell by double digits. Foot traffic dropped. Customers did not gradually adjust to the new pricing logic. Many simply stopped coming. The company's leadership had anticipated a period of adjustment, but not at this scale. The decline was faster than internal models had projected. As revenue fell, the strategy became harder to sustain. Remodeling stores required capital. New brand partnerships required inventory commitments. Without promotional levers, there were few tools to quickly stimulate demand. The very elements removed to create clarity had been the mechanisms that allowed short-term course correction. Internally, tensions grew. Some executives argued for reintroducing promotions, at least temporarily. Others worried that retreat would signal weakness and confuse customers further. Johnson remained committed to the vision. Reversing course, he believed, would only deepen the brand's identity crisis. The strategy needed time. Time, however, was constrained by cash flow. JCPenney's fixed costs were high. Large stores, long leases, and a national workforce left little room for sustained revenue shortfalls. As losses mounted, the company drew on credit lines and sold assets to fund operations. Investor patience eroded. By late 2012, the board intervened. Promotions were partially reintroduced. Coupons returned in modified form. The pricing message shifted again, attempting to blend the new philosophy with remnants of the old. The result was not synthesis, but inconsistency. Customers who had left did not immediately return, and those who stayed encountered a store unsure of its own rules. In April 2013, less than 2 years after his appointment, Ron Johnson was removed as CEO. His departure marked an acknowledgement that the transformation had failed to stabilize the business. But the damage was already embedded. JCPenney had lost billions in revenue, weakened its balance sheet, and unsettled its customer base. The leadership that followed faced a narrower set of options. They worked to restore familiar pricing practices and repair vendor relationships. Some customers did return, but the competitive environment had continued to evolve. Online retailers had gained further share. Off-price chains attracted value-oriented shoppers with a different model altogether. Malls themselves were in decline, reducing the natural traffic JCPenney once relied upon. Debt accumulated during the failed turnaround limited flexibility. Investments in technology and logistics lagged behind competitors. Store closures began, not as strategic pruning but as necessity. Each closure reduced scale, making remaining operations less efficient. By the late 2010s, JCPenney was no longer positioned as a stable legacy retailer undergoing adjustment. It was seen as distressed. Suppliers tightened terms. Creditors exerted influence. The company's fate became tied to broader pressures facing brick-and-mortar retail, but with fewer resources to respond. In 2020, amid the broader economic shock of the COVID-19 pandemic, JCPenney filed for Chapter 11 bankruptcy protection. The filing was not sudden. It followed years of declining sales, shrinking footprint, and financial restructuring attempts. Bankruptcy allowed the company to close additional stores, renegotiate leases, and reduce debt. It also marked the end of JCPenney as an independent public company. Later that year, the brand was acquired by a consortium of mall operators and investors. The stores that remained continued to operate, but on a smaller scale. The role JCPenney once played as a central, dependable fixture of American retail had diminished. The failure of JCPenney was not the result of a single misstep, but the compression of many pressures into a narrow window. The strategy that accelerated its decline was not irrational. It was coherent, ambitious, and grounded in real critiques of the old model. What it misjudged was the relationship between the company and its customers, and the speed at which that relationship could be rewritten. For generations, JCPenney had been part of a routine. Families shopped there not because it was innovative, but because it was consistent. The promotional structure, however inefficient it appeared from a strategic distance, was woven into that consistency. Removing it was not a neutral upgrade. It altered the meaning of the store. JCPenney's collapse revealed how fragile legacy advantages can be when they are misunderstood. Scale, loyalty, and familiarity do not behave like modern branding assets. They are slow to build and easy to disrupt, even by those trying to preserve them. The company had once translated the rhythms of American life into aisles and catalogs. When those rhythms changed, and when the response arrived too abruptly, the institution could not adjust fast enough to survive intact.